The next concept that we will be covering is the realization concept. Realization concept states that revenue should be recorded when it is realized. Okay, so as per this concept, revenue should be recorded by a firm only when it is realized. What does that mean? What that means is that probably you may have carried out some transaction, you are expecting the revenue should be recorded into your books of accounts only when you have received it. Let me give you an example. You have carried out a sale. Let's say you have sold your phone. Now, the person to whom you have sold the phone, he has, unfortunately, at this point of time, does not have the money with him. So he's told you, I will pay you after 2 years. Okay, so the credit period that he's asked for you is 2 years. So you have carried out the sale. The money is due to you. You have not received the money as yet. But according to realization concept, this revenue should be recorded only when the business receives it. Okay? Only when the business receives it, that is the time when you have to go about recording this into your books of accounts. That is what is meant by a realization concept. The next concept that we will be covering is the accrual concept. Accrual concept states that expenses should be recognized when it becomes due for payment. You may have incurred some transaction. You have to make the payment. You're not ready to make the payment right now. You will be making the payment at a later date. But when you are ready to make the payment, that is when you should be recording that particular expense. So that expense has to be recognized when it becomes due for payment. Okay? That revenue has to be recognized when it becomes, expense has to be recognized when it becomes due for payment. Next is accounting period concept. Accounting period concept tells us that the financial statement should be prepared for every accounting period, and you have to prepare the final accounts at the end of the accounting period. Also, the accounting period, once you have decided, you should not keep changing. Now, in Indian context, this accounting concept does not have much relevance. The reason being, the government has prescribed the accounting period to be 1st of April to 31st March. Okay? So the government has prescribed the accounting period to be 1st of April to 31st March. So that's a prescribed accounting period. So you have to ensure that you carry out your transactions within this accounting period. That is what is meant by this accounting concept. Next, you have matching concept. Matching concept tells us that revenues of a period should be matched with the expenses of the same period. Okay? So revenues of a period should be matched with the expenses of the same period. What does this mean? So imagine I take the revenues for 2017 and expenses for 2018. Okay? That is insensible. There is no logic behind that. So when you are taking an expenses for a specific period, you also have to take the income for a specific period. You cannot take one period's expenses and another period's income. So 2016's expenses, 2018's income, not working out. It has to be the same period's expenses and incomes. That is what is meant by matching concept. So with that, we have covered the accounting concepts. Now we are moving on to the accounting conventions. What are accounting conventions? Accounting conventions are methods and procedures which have a universal acceptance. It has universally acceptable. It has got a universal acceptance. And then what happens is that it must be followed by a firm during the preparation of financial statement. Okay? It should be prepared by a firm during the preparation of a financial statement. So please remember, accounting concepts, though they were assumptions, okay? Accounting conventions, these are best practices. Accounting concepts, they are given to the accountant to prepare the books of accounts. Accounting conventions are for preparation of final accounts, especially preparation of financial statements. So that is accounting concepts and the accounting conventions. Now, moving on, there are 4 conventions that we'll be discussing about. The first convention is convention of consistency. Okay, the first convention is convention of consistency. Convention of consistency tells that financial statements can be compared only when the accounting policies are followed consistently by a firm over a period of time. What does this mean? What this means is that when you have adopted a specific accounting practice, you have to uniformly follow that. I'll talk about this with an example. We know that to calculate depreciation, there are different methods. You have straight line method, you have written down method, you have annuity method. So let's say I have bought a car and I want to charge the depreciation of that car for 10 years. For the first year, I use straight line method. Second year, I use written down method. Third year, I use annuity method. Okay. There is no consistency. Every year, I have changed my method. That is what is meant by accounting convention of consistency. Okay. That is what is meant by accounting convention of consistency. So financial statements can be compared only when the accounting policies are followed consistently by a firm over a period of time. Now, when can you change? You can change the accounting practices when there are special reasons, when there are special circumstances. If you have any specific motivation, if there are some specific reasons for you to change, that is when you can go for accounting convention. That is when you can change your accounting practice. So convention of consistency tells you that you should follow an accounting policy of a company for a fixed period of time. Second is convention of full disclosure. What does this mean? The convention of full disclosure states that the financial statement of a company should be prepared in such a way that it fairly discloses all the material information to the users. Which means when you are preparing the final accounts of a firm, you should not hold back any transaction. You should not hide any transactions. All transactions which have been incurred by the firm, it has to be disclosed to the, That is what is meant by convention of full disclosure. So convention of full disclosure states that all transactions that have taken place in a business, it has to be disclosed while you prepare your final accounts. Okay, while preparing the final accounts, you have to ensure all possible transactions of the firm, it gets disclosed. Next is convention of materiality. Now, this convention states that only those items which are relevant has to be disclosed in the final accounts. So what convention of materiality, what it states is that only items which has got a significant economic effect should be showcased into the in the final accounts. Now, this may be very confusing for you because in the previous convention, we just learned that all transaction has to be disclosed. But here, we're telling that only transactions or only items which are relevant, it has to be disclosed. It may be very confusing, but I can explain this to you. Here's the deal. In your firm, because as a part of the office needs, you may be buying pencils, you may be buying pen, you may be buying paper, you may be buying books, you may be buying diary, you may be buying different types of stationery items. So while preparing the final accounts, you have to ensure all transactions are disclosed. You have to ensure that all possible transactions of the firm, it is disclosed. Okay? So that is one aspect you have to follow. But instead of showing pen, pencil, eraser, sharpener, paper, etc., what you can collectively do is put all this together and then show that as stationery, that would be more relevant. Okay? So what convention of materiality states is that wherever you have a window, wherever you have a possibility to compress the items, you have to ensure that it is all collated, it is all compressed together. But at the same time, you also have to ensure that no possible transactions are hidden, no possible transactions you fail from disclosing. That is what is meant by convention of materiality. The last convention that we will be learning is convention of conservatism. What is meant by convention of conservatism? Convention of conservatism states that the firm should not anticipate incomes and gains, but it should provide for all expenses and losses. What this convention states is that you should anticipate all incomes and gains, but you should provide for all expenses and losses. So what does this mean? What this means is that you should not hide or you should not overlook the possibility for you to gain income. At the same time, you should not hide any possible expenses. So for example, if the management asks you how much is the profit we are likely to make, you're quite sure that you will make only a profit of 1 lakh. But you create a false expectation saying that, oh, this quarter, for sure, we will make 10 lakhs profit. Now, what you're doing is wrong. You're violating the convention of conservatism. Or let's say you're carrying out an activity, and for that activity, you are sure that you will have an expense of 10,000. But when the management asks you, how much will the total expenses be? You should not be lying and saying that, oh, we will only have an expense of 10,000 rupees. You're violating the convention of conservatism. So with that, we have learned accounting concepts. We have also learned the accounting conventions. We've learned 4 conventions. The 4 conventions are convention of consistency, convention of full disclosure, convention of materiality, and then convention of conservatism. So these are the 4 major accounting conventions that we have come. So with that, dear students, I put a pause